Imagine you just downloaded a dating app. You fill in your profile, upload your best photo, write something clever in the bio, and then you swipe right on someone way out of your league. The algorithm looks at you for about 2 seconds, then it decides, nope, that's your credit score. Every single time you try to buy a house, get a car, or even rent an apartment. And here's the part nobody tells you. The algorithm isn't just looking at whether you pay your bills. It's watching things you'd never think matter. Stay with me, because the one that trips most people up. I'll get to it at the end. Okay, real quick, what even is a credit score? It's a number, 3 digits, somewhere between 300 and 850. And that number tells lenders, banks, landlords, car dealers, how risky you are as a borrower. Think of it like your Yelp rating, except instead of reviews about your pasta, it's a review of whether you're trustworthy with money. A score under 580? That's basically a 1-star review. You're getting rejected or paying absurdly high interest rates. A score above 740? Now you're looking good. Lenders start competing for your business. The most common scoring model is called FICO. Most lenders use it. But here's what most people don't know. There isn't just one credit score. There are dozens of versions. Mortgage lenders use a different one than car dealers, which is why checking your score once and thinking you're done is a mistake. So back to the dating app analogy. When the algorithm judges your profile, it looks at 5 things. First, payment history. This is 35% of your score. It's the biggest chunk. Think of it as your main profile photo. If this is bad, nothing else matters. Pay late even once, and it shows up on your profile for 7 years. Second, amounts owed. 30% of your score. This is your bio. Specifically, it's about credit utilization, how much of your available credit you're actually using. The rule of thumb, stay under 30%, ideally under 10%. If you have a $10,000 credit limit and you're carrying $4,000, that's a red flag to the algorithm. Third, length of credit history, 15%. This is basically your dating profile saying, been around a while, not new to this. The longer your oldest account has been open, the better, which is why closing an old credit card, even one you never use, can actually hurt you. Fourth, credit mix, 10%. The algorithm likes to see that you can handle different kinds of debt. A credit card, a car loan, maybe a student loan. Variety is attractive, apparently. Fifth, new credit, 10%. Every time you apply for something new, lenders do a hard inquiry on your file. 1 or 2 is fine. Apply for 6 cards in a month. The algorithm thinks you're desperate, and desperate is not a good look. Now here's where it gets real. Your credit score doesn't show up on your tax return. That's a common mix-up, but it does affect your financial life in ways that hit just as hard. When you buy a home with a credit score of 620 versus 760, we're not talking about a small difference. We're talking about potentially $100,000 more in interest paid over the life of a 30-year mortgage. That's money gone, not invested, not saved, just gone. And here's the tax connection people miss. Mortgage interest is tax deductible. But if your rate is sky high because your score is low, you're paying way more to get that deduction. You'd be better off with a lower rate and no deduction. Your score also affects your insurance premiums in most states, your security deposits, even some job applications. It quietly touches more parts of your life than almost anything else. Okay, earlier I said there's one thing that trips most people up. Here it is. People assume that paying off a credit card balance or closing an account they don't need makes their score go up. It feels logical, but it can actually make your score drop. When you close an old card, you lose that available credit limit. Your utilization ratio goes up, even if you haven't spent a single extra dollar. The algorithm sees risk where there was none. Same with paying off a loan completely. That's obviously good for your wallet, but it can temporarily ding your score because it reduces your credit mix. The algorithm is a little weird like that. And a lot of people try to game this by checking their score constantly. Here's the thing, checking your own score is what's called a soft inquiry. It doesn't affect your score at all. It's when lenders check it, a hard inquiry, that it matters, so check away. So what do you actually do to improve your score? Not the generic advice. The stuff that moves the needle. 1. Pay on time every time. Set up auto pay for at least the minimum. Missed payments wreck you for years. 2. Get your utilization below 30%. If you can swing it, below 10% is where scores really jump. 3. Don't close old accounts. Keep them open, even if you are not using them. 4. If you have no credit history, get a secured card or become an authorized user on someone else's account. That's the fastest, legitimate way to build from zero. 5. Check your free credit report at annualcreditreport.com. Errors are more common than people think, and disputing them is free.